Hello, friends. Welcome to Nirmal Bang. I'm Piyush Jain, and today we are bringing to you a new IPO, a company basically which has created a strong distribution network over the last many years. It is distributing brands, products of more than 40 brands, and is extremely active in the IT space, IT distribution space. It is providing end-to-end value-added services such as pre-sale activities, solutions, technical support, marketing services, trade solutions, and warranty management. The name of the company is Rashi Peripherals Limited, and today the management is joining us. Mr. Kapil Suresh Pansari, the managing director of the company, and Mr. Rajesh Goenka, the CEO of the company. Gentlemen, welcome to the show.
Thank you.
Let's start with the foremost question, which everybody would be trying to know about the brand, its history, its journey, how this all came about. Because let's not forget, it's not so easy to create a distribution network for any business, whether it's FMCG, IT, or any business. And whosoever is able to create a distribution network, then they then actually start commanding a value proposition. So help us understand how it actually all began for you.
Yeah. So the company was founded by two gentlemen, Suresh Pansari and Kishan Chaudhary, back in 1989. They are both chartered accountants by profession. They completed a chartered accountancy into 1980 and practiced chartered accountancy for 2 to 3 years. In 1983, they got an opportunity to enter into IT business called printer of ribbons in the for printers.
That is inspiring, like from finance expertise to IT. Please continue.
So when they started this printer manufacturing, within about 4 to 5 years, they garnered almost 30 to 40% market share in the country by being aggressive.
Okay.
With that first level, they got the confidence of then importing other IT category products into the country, and kept on going forward. While their journey, they getting this confidence. They corporatized this operation into Rashi Peripherals Private Limited in 1989, and from there onwards, they started bringing more and more products, opening more and more branches across the country. And in 1994, Asus brand, which was world's number one brand and the most expensive brand, came to Mr. Suresh Pansari and Kishan Chaudhary, Rashi Peripherals, to distribute them in the country. India being a price conscious and value conscious country, Asus was most expensive and was struggling in the country. With hard efforts of both these gentlemen, within about 3 years, 3 to 4 years, they garnered almost 30% of the India's market share. Looking at this growth, the Swiss technology company called Logitech came to them to request for their help to similarly expand their presence in the country. They were struggling at about 5 to 10% in the India from the in the market, because they were also almost 5 times expensive than their Chinese counterpart in keyboard and mice segment. Within 3 years, they could achieve almost 30% market share again in the country.
That's amazing.
After that, then products kept on adding. Then storage devices company Sony came to India for floppy disk drives and optical drives. This gave the confidence and a base to keep on adding new products year after year, going to new markets, opening new branches year after year. And Rajesh joined in year 2000, and then he professionalized and took forward the company.
I would say actually I basically used to buy Logitech. So that actually tells that how much improvement you would have done in the brand image, because we actually had a perception that Logitech is an excellent brand.
Thank you.
So apart from these, what are the other top brands which constitute top 10% of your revenue?
Yeah, so overall, we currently have 52 brands, global marquee brands. The leading brand in terms of top line is Asus, followed by Lenovo, followed by Western Digital, and then Intel and other brands.
Okay.
What is very important in Rashi Peripherals is our dependency on one product or one brand is very limited. Currently, top 8 brands contribute to 82% of our revenue, which is a very safe and well spread business. And this
Absolutely.
is actually helped us to maintain our CAGR growth of 20% for last 20 years.
Mhm. Uh, but sir, how it is basically from the perspective of contracts? How long term are these contracts? Because while distribution network you command, the sort of longevity of revenue is being determined by the contracts and by the obviously clauses.
Absolutely. So you're dot on. In the IT industry, these contracts or these relationships are very, very long term. So much so that since last 25 years, we are the preferred and the largest distribution partner for Asus. Similarly for Logitech. But on agreement per se, on paper, if you see the agreements are normally valid for 1 year to up to 5 years, and they are auto renewed. There are hardly any cases of agreements not being renewed.
So
So whatever,
are you saying, for example, if you have 52 brands, if the number I'm saying is right, if there are
yeah,
52 brands, you're saying that none of the brands have ever left you?
yeah. So virtually no. There could be only 3 or 4 brands which we have mutually left because technology progression has not happened or that company has not come in scale. But otherwise, no.
Oh, okay.
And Asus is the biggest example. Since last 25 years, we are working with them, and they are a substantial portion of our business.
This might not be as important to you, but from a stock market perspective, I'm slightly tempted to ask you why the contracts have been done for 1 year with RNE renewable clause. Why they're not actually being desired by design like 5 year, 10 year contracts?
So as I said, the agreements are different. Vendors have different agreement periods, varying from 1 years to 5 years. So there
Okay,
are few agreements even for 5 years, and then they keep on auto renewal. So it depends on the vendor to vendor.
okay, understood. And from that perspective, like how the sort of revenue model works for you? Like you take a percentage of sales, or like it's sort of JV agreements with them, some shareholdings. Like how it works for you?
Yeah. So normally this is a distribution relationship agreement with all these global marquee brands. The way this distribution model or the revenue model works is that these brands assign credit limits based on our financial strength and capability. And
Mhm.
we buy these goods on credit from these brands.
Okay.
Based on that credit limit assigned, when they supply to us on credit, we hold a certain days of inventory on our books. And this is then further redistributed to our branch network of 50 branches, 50 warehouses across the country. While we keep this inventory, we sell also to our customers on credit. Please remember that Rashi Peripherals is a B2B company. So we do
Mm.
not sell to end customers directly, but we support, and our entire infrastructure is to support our customers, which are channel partners in various capacity and forms,
Mm.
where they sell to end customer and service their end customer needs. So
Okay.
when we sell this to credit to customers, uh, we recognize the revenue, and during this journey, we buy on a certain price from these vendors, and there is a margin that gets marked up on these products, and we sell to the customers. That's how we earn margins.
Right, sir. And now the question is, your working capital is not looking that bad. It's actually looking all good from a perspective of a distribution network, which is taking advantage of credit periods. How the working capital is being structured?
Yeah. Usually, what happens is these credit limits that we get from these brands ranges from 30 days to 45 days from our suppliers.
That's not bad. It's like quite fast moving then. I was
Absolutely.
actually I was first guessing it might be 3 months, 4 months, but no, that is very much swift.
Correct. The usually the cycle is 30 days cycle. We keep inventory for about 50 to 55 days, and we also give credit from 30 days to 45 days. So usually what happens is the debtors and creditors knock off each other, and what the investment is only on the part of the inventory. So that's the ability for us to continuously keep efficient inventory cycles so that we can, one, reach to the length and breadth of the country, and second, make sure the availability of each of those queues are adequately mapped so that customer demands does not get lost.
The way I'm reading numbers is, sir, that you don't have very heavy assets on your book. Like, how's the business, sir? Is it like your warehouses are there, the office are already there, and basically there is a centralized space, and then you are sending out the stuff. Uh, there is not much asset investment now, sir. How is it?
Correct. This is a very asset light model. We do not have our own offices. We do not. Today, offices are on rent, warehouses are on rent, and even the logistics are there enough efficiently managing third party logistics companies who can do a better job of managing third party logistics and than what we can do on our own. So that's why we utilize those services. For us, assets are so small, most of the capital deployed are in the working capital cycle itself.
I understood. And the reason why I asked this question was because there was a disproportionate increase in the return on equity. Like from FI, obviously 20 must have been a COVID period. 21 must have normalized slightly. But your ROE are like stellar. You actually are almost in 35 to 40% range. Very strong return on equity. Very good return on capital employed, almost 20-25%. I think this is going to be liked by most of the stock market participants. What is the sort of secret sauce behind this, sir? Strong return capital employed.
So it is all like I mentioned, this is a working capital cycle. So the number of times we rotate the capital that is deployed in the business determines our ability to generate ROC and ROE. So
Hmm.
if you have a better working capital cycles, obviously the efficiencies are higher. In
And
our
what's the asset turnover you're commanding?
So we are doing a asset turnover is between. So I can tell you our working capital cycle ranges from 6 times to 7 times in a year of the capital that is deployed. And
That's good.
during COVID, what you saw, we because the demand for IT electronics were higher, we could do this asset turns by about 9 to 10 times, which
Oh, wow.
obviously increased seller performance.
That's very good. I think good to know. I think for all the investors. Um, Net debt to EBITDA, sir. How much net debt is on the books right now?
So total debt on the books is about 1100 crores.
Okay. And either of you can answer this. How much funds you're raising from this IPO?
We are raising up to 750 crores in this IPO. 150 crores has been provisioned for pre-IPO, which is we have already completed. This IPO is going to raise at about 600 crores in the organization. And this entire, I want to highlight that this entire capital raise is primary and fresh. There is no OFS or secondary. So the money raised will go into the growth of the organization.
Right, sir. And what is the fund usage going to be?
The fund usage, part of the fund usage is going to be about 475 crores will be used in repaying the debt. Because when you raise this capital and we will not have immediate business opportunities to deploy entire money into the working capital cycle. So temporarily we'll partially pay the debt that is there on the books. And the balance is to pay the creditors so that we generate higher credit limits and enjoy credit limits from our suppliers for future growth.
Makes sense. And the debt which you are paying is largely a long term debt, or you're paying your credit facilities?
See, these are all short-term credit working capital facilities. We do not have any long-term debts.
So practically, this fundraise is actually going to open up more credit facilities for you, and that in turn actually creates more opportunity for creating more turns. Actually,
Absolutely.
okay, sounds good. Sounds good. From the other perspective, also one small question, sir, is that on the indirect tax. There is a small sort of number in the contingent liability which I was noticing, and I thought it's worthwhile just discussing and mentioning that just to have a clarity. There was an indirect tax contingent liability of 127 crores. What's the status right now? Is it already solved? Is it there? Like, what's the reason? How we should read it?
This is during the process of our IPO, there are a lot of compliances that we have to disclose any tax litigations and the ongoing cases which are not closed. However, what happens is these are almost no real liability is expected out of the investigation that was there in place. So, as a part of disclosure, this is mentioned. However, since we do not have a closure from the department yet, obviously
Hmm.
we are obliged to inform our respective investors, prospective investors of what is currently open. So we do not foresee any real liability.
Okay, makes sense. Let's also understand now what is the plan. 52 brands already there on the distribution network. Obviously, it's a huge population market, young market. Everybody knows electronic consumption is growing, different brand consumption is going. So, how it looks now? What's the plan from here? You're going to get more money, a lot of money from this IPO also. So, basically, how is it looking to you?
So we are very excited with the current market trends because of the digitization that is going on across the country, led by our Prime Minister. The IT demand continues to grow. All third-party data shows that IT demand in next few years will continue to grow at a CAGR of double digit. So even if we maintain our existing businesses and market shares, we will continue to grow double digit. But what is very different at Rashi is that we continue to explore new opportunities in terms of new verticals, new solutions. And as a part of that initiative, about 4 years back, we got into enterprise vertical, where we are currently selling solutions of servers and storage. Uh, Coincidentally, because of the data localization, the mandate given by Government of India, there is a surge of demand in server and storage, and we are one of the beneficiaries of the same. Similarly, in artificial intelligence, which is the in thing right now, everyone is talking of AI. So again, Rashi Peripherals is one of the largest and the oldest partner with NVIDIA, which is a global leader in AI. And all the AI installations that are coming up in India, and so many announcements have been made. Again, we have a significant role to play. And similarly, in the semiconductor space, which now everyone is exploring to set up a fab in India, and Micron setting up a testing facility in Gujarat. And coincidentally, Rashi Peripherals already has created this semiconductor vertical within the organization. And we are also already an authorized distribution partner for, as an example, Micron or Qualcomm or Intel, NVIDIA. So all this put together, and more importantly, and equally importantly, the faster growth rate that is coming from the non-metro locations, especially the BCD class cities. And since Rashi Peripherals is physically present in all these 50 cities of India with our infrastructure of branch offices, warehouse, and service center, gives us an added advantage. So with the cumulative of this, we are very confident of maintaining our 2x growth. And in our history, of course, says that in last 20 years, we have a CAGR growth of 23%.
Right. I'm also want to ask you, sir, in terms of the brands, like as you know, as per the manufacturing and make in India, all the sort of policies Indian government is pushing for, there would be Indian brands also, sir, right? Who would be actually coming to you for really sort of distribution network? Like how is that happening, or like how is it?
Yeah, so there are two things. One is because of the local manufacturing going up, we have a double advantage. We can supply parts and component to these manufacturers, and in turn we can buy the ready-made goods from them. So same product, one is supplied to the manufacturers and then buying the ready-made product and distributing. So that's one. And all the global companies are now setting up factory. They have PLI schemes from the government. Some 31 companies have got the PLI scheme. Second, there are local manufacturers also which are coming up, and we are keeping our eyes open. But basically, our criteria for tying up with the brand is that they should either be inventor or leader in the technology, because then it becomes a long-term and sustainable business model. Like for example, Asus, I mentioned, we are working with them for now 25 years. Logitech, we are working almost 20 years plus. So that's our criteria for joining hands with the vendors.
Well, makes sense, and that also again basically creates long-term opportunities from the perspective of growth. Perhaps the numbers actually speak for themselves. Perhaps my last question with the funds, and I'm just thinking around. Suppose 600 crores is going to company, you pay off the debt. 600 crores is freshly available for credit limits, and the asset turns, if you were actually telling me, is around 6 times. Was that the right number which I was remembering?
Correct.
Right. So basically, what I should imagine now with this 600 crores, it actually paves way for sort of 3,000 crore revenue. We're not
Yeah.
forecasting, but I'm just thinking, what is the optimal sort of capacity here?
Yeah. So what we do is that apart from the equity, so the currently the company's net worth is a result of last 3.5 decades flowing back of profits into the organization. By plowing back that into the organization, every year the equity and the net worth base kept growing. And this gave us the advantage of continuously increasing the ability to buy more and then sell more. Apart from this, we also use debt very prudently. And internally, we have benchmarked by 1 is to 1.5 times of our equity debt. This combination put together, by rotation that we just mentioned to you, is the capacity and the working of our revenue growth projections.
Well, this sounds good. A sector which is going to expand and expand. So perhaps the market is hot. You don't have any major debt. That is actually the beauty of the business. Working capital asset turns are very strong. Return ratios are very strong. 52 brands you're holding on your distribution network. Strong distribution network. Years of legacy. I think this all actually paints a very good story for an IPO. So I think with that, I think we'll extend best wishes for a very successful IPO to both of you and the company. Hope to stay in touch when the results come. But from our side, all the best to you.
Thank you so much.
Thank you, Piyush.
And dear viewers, I hope you enjoyed this conversation. For now, it's a wrap on this conversation.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.